$5. And a little clarification. We will not trade levels, but you should understand this. For example, the global Bitcoin graph is a monthly graph since 2018. More precisely, a weekly graph. The maximum of the previous cycle after the break in 2020 became support. That is, this zone was a resistance for the price, and the price, after testing these zones, showed some downward reversal movement. Then, after the break of this maximum, this level, which was a resistance, became a support for the price. The break of the previous maximum makes it a support. And as we can see here, with a small shadow on the weekly time frame, we can see this movement. How did it go? The price tested this level and went further up. It formed a maximum, after which there was a market reversal in the spring of 2021. The price fell again, and then the price rolled back to this maximum. First, we have a point where the global reversal began. This is a round number plus the previous maximum. That is, there is a certain level in the form of the previous maximum from which the price has already turned around. The second is a round number. That is, the round number is $70,000. In the current cycle, the price has turned around the round number. That is, these zones were a resistance to the price, and the price, after testing these zones, began its bearish trend. This is a monthly time frame, it seems. So, the price, as you can see, has reached the level of $28,000, $29,000. As we can see, after the fall in the spring of 2021, the price stopped right here. After the fall at the end of 2021, the price again stopped at the level of $30,000. But then this level was broken, and from the point of view of the theory of classical understanding of the level, $28,000 will be some kind of resistance for the further growth of Bitcoin. But again, I repeat, we will not use our trading for support, resistance, and so on. This is a simple tool for you to understand the logic of graphical patterns. Breakthrough level. The level is a price area that can show a reaction, can support the price or resist it. And this belief is based on probability. But there is no guarantee that the level must withstand the pressure and it can be broken. There are two types of breakthrough. This is a true breakthrough, and a true movement is usually formed after a false breakthrough in the opposite direction. And a false one is when the price breaks the level and then returns to the level again. That is, for example, in the previous maximum of Bitcoin, this is a resistance level. We have a breakthrough level, but without fixing the body of the candle, which indicates the possibility of forming a false breakthrough. That is, the price came and then turned around, came again and turned around again. This indicates the weakness of the bull trend. After that, the price reaches the level of $29,000, $30,000, and we see that here we had trading, 1 trading, 2 trading, 3 trading, 4 trading. But then there was a true breakthrough of the level, fixing the candle below, and this support, green, as you can see, now became a resistance and will be, in the classical understanding of technical analysis, a resistance for the price. The theory of classical technical analysis. The essence of analysis. What should your analysis be based on? It is necessary to know the following indicators. The first is macroeconomic factors. The second is the cyclicality of the asset. The third is the price, and the fourth is time. We will devote most of the time to the price and time, specifically to the chart. We will study this further. What should not be paid attention to when analyzing? You should not pay attention to news, rumors, opinions of experts, traders, analysts, intuition, feelings in the form of greed and fear, etc. You should not pay attention to this. Your analysis should be based on macroeconomic factors, on the cyclicality of the asset. That is, the usual asset in March grows over the last 30 years, or falls. we should pay attention to the price and time. Deposit management. How to choose your trading deposit. At the very beginning of your path, you need to practice on demo accounts. After the path of gross mistakes from mechanical and technical numbers is passed, experience is gained, and the trading system is built on its basis, you can switch to real funds. The real account must create psychological pressure. The practical path, through the test of fear and greed, gradually develops emotional immunity. All people have different thresholds of risk sensitivity, and this factor should be the main one in choosing the starting balance of your real deposit. I have a rule. How to choose your trading deposit. Very simple. Profit at 3% from the transaction is pleasant to you, and loss at 1% is unpleasant. This way, you will experience pressure. This constant pressure will generate emotional immunity for trading this deposit, and accordingly, there is already an increase in the deposit and the same path in the form of the development of emotional immunity. What to do if you don't have a large deposit? You have two ways. The first way is prop trading companies, FTMO, MFF, TFF, and many other prop trading companies. The essence of them is that you buy a challenge, that is, some exam, pass this exam in several phases on demo accounts, and after that, you are provided with real money in management. An exam for a deposit of $200,000 costs about $1,000. If you pass it, you will be given a real account with a trade in the amount of $200,000, and you can earn from it. The disadvantage of this way is that there are limitations on the loss per day, loss per month, and so on. The next way is to trade small deposits for the sake of collecting statistics and confirming the condition of your trade. And after that, the investors will find themselves without any problems.
Risk management of the transaction is an important part of capital management. When opening a position, we have three important values. The first value is the price of entering the transaction. The second value is the price of a potential loss, that is, the zone where our scenario is canceled. And the third value is the price of a potential profit, that is, the zone in which we plan to close our position to the plus. Each of these zones must be based on technical analysis and have a logic of how it is set up, where to enter the transaction, how to set a stop loss specifically technically, and where to fix the profit more correctly. In terms of technical analysis, you will learn a little later. But this should be your warning that neither stop loss nor take profit is set up for no reason. Visual display of the position is possible using the following TradingView tools. This is a long position and a short position. A long position means a long position. A short position means a short position. Here is an example of the visualization of a long position, or a simple purchase. In this case, this line between blue and gray will be the point, let's say, the price of the entrance. As we can see, this price is $21,597. This minimum is the minimum at which our scenario is canceled. Accordingly, we draw a stop loss here. That is, this gray area is drawn by this tool. And then we have some, let's say, a liquidity pool at a price of $22,445, and we draw a take profit zone right there. Accordingly, we get some values. The first important value we get is this figure, 3.14. What is it? 3.14 is the ratio of your profit to risk. That is, your profit is 3.14 times more than your risk. Accordingly, if you make your transaction 1% risk, and how exactly to make 1% risk I will explain, then in case of loss, you lose 1%, and in case of profit, you earn 3.14% of the deposit. Let's talk about risk calculation and reward for risk. Risk standards. The reduced risk is 0.25, in the range from 0.25 to 0.5, and also up to 0.75. The basic risk is 1 to 2% for a transaction, and the high risk in a transaction is above 2%. The tool for visually displaying positive TradingView allows you to automatically calculate the risk, that is, calculate the volume of the transaction that you need to enter, taking into account three values: input, stop, take. The reward for the risk is the ratio of the risk to the potential profit. The acceptable ratio is 1 to 3. That is, when you roughly planned your transaction, pulled, let's say, this visual tool, a long position on the schedule, pulled the stop-loss line, pulled the take-profit line, and we got a value above 3. Accordingly, this transaction is higher than 1 to 3, and this is a good indicator. That is, statistically, if your trading system will have, let's say, 60% loss transactions and 40% profit, you will still be in profit, due to the fact that you lose 1% in the transaction, but if you earn 3%. How to calculate the volume? The volume is calculated here. That is, 0.37 is the volume that you should enter. Why exactly this volume? It is automatically calculated if you click on this tool twice. You will get such a setting. You enter your deposit here, let's say $10,000. Do not touch the lot size on the cryptocurrency market, and specify the risk of 1%. Accordingly, if we go for all $10,000, that is, we buy Bitcoin for all $10,000 at a price of $21,597, at stop loss, we will lose not 1%, but we will lose the percentage that makes up the percentage of this movement. This is 1.25%. You see? That is, how do we reduce the risk? We need to go for a smaller volume, because there may not be such a figure. There may be 5%. That is, the movement from the entry point to the stop point is 5%, but you do not want to risk 5% in the transaction. How can this be done? Go for a smaller volume. And how to calculate it? Very easily, because thanks to such a calculator, your volume is automatically calculated. 0.37 Bitcoin is necessary to buy in this transaction at a price of $21,597. That's so that in the event of a loss and the price reaches $21,327, you lose 1% and not 1.25%. But in the event of a profit, you will not earn 3.93%, but you will earn 3.14%. Here is such a simple math. There is nothing complicated about it. But this is the most important point regarding the calculation of the risk and the reward for the risk. What should be learned here? It is important for you to understand that you must control the risk, control the volume of your transaction, because, as I have already mentioned, if your trading system has 60% loss transactions with an average ratio of 1 to 3 in transactions, you will still earn money. Let's go back to this slide. Guess the movement by 100%. There is no need to earn. Statistics are on your side. Accordingly, if, for example, the liquidity pool is somewhere here, and when you pull, let's say, the take-profit zone here, it will be 1 to 1. Therefore, in the case of 60% loss transactions, your deposit will be in the minus. In order for your deposit to be in the plus, you should have a much higher win rate. The number of profit transactions should be much higher. Therefore, I recommend working with a ratio of at least 1 to 3. A useful tip about capital management. Set a risk for a day, week, month. Let's say you can risk 10% per month. Accordingly, we have 4 weeks per month, and accordingly, you set 2.5% per week. Accordingly, you choose specific days per week and trade: Monday, Tuesday, Wednesday, Thursday, Friday. And in accordance with the results, you already adjust your management. Let's say if you got a stop loss of minus 1% on Monday, you have 1.5% risk left this week. You can break it by 0.5% and trade 0.5% for another 3 days. If you get a profit, you can accordingly increase this risk. That is, let's say a risk of 1% per day, a risk per week is 4%, and so on, and so on, and so on. And do not exceed the threshold. This is some condition, well, you will create it for yourself, comfortable for you, according to your risk profile, and do not exceed the threshold of this risk. Do not use credit and loan funds for your psychological calm. Do not use loans and banks, money and debt, and so on, and so on, and so on. The higher the ratio of risk to profit, the better for you. That is, if you have a deal not 1 to 3, but 1 to 10 or 1 to 15, this is great. You earn 15% with a risk of 1%. But statistically, as the level of profit fixation increases, that is, the level of take profit, that is, the ratio of risk to profit, from 1, let's say, to 5, from 1 to 20. Accordingly, statistically, the probability of a successful deal is reduced. That is, you will take 1 to 3 more often than 1 to 20. And accordingly, a big question becomes here. And what is better? Take 1 to 3 more often and enjoy the 3% profit, or catch a series of stops and then catch a 1 to 20 move. This is a question for discussion. Fourth, creating a deal plan and adhering to it. That is, you must create a deal plan, as I have already described, with an entry, with a stop, and a take profit, and adhere to this plan. No need to chase the market. No need to move the stop lower, lower, and so on. Or, if you buy, or if you short, move it up, fearing this stop loss. It is better to get the stop loss and draw conclusions. And in the same way with take profit. If you initially planned a 1 to 3 deal, and in 15 minutes it takes you away, and it is already 1 to 2.5, almost to take profit, and you think, let me draw a 1 to 5 take profit, and set the order of the take profit to 1 to 5. You do not need to do this. It is better to take these 3%. At the very beginning of the path, it is not worth doing this. All manipulations with a stop loss and all manipulations with a take profit are possible when you understand practically any movement on the market. Then it can be done. When you have an ideal, graceful management of capital, transactions, and so on. At the beginning of my path, everything I say here is advice for beginners, for those who are starting this path. These are my advice for you. The next thing is to create your own risk management rules that fit the risk profile. Let's say there are people who can trade 5 to 6% of the risk. Well, the other thing is whether the trading system, in my trading, I can trade 5 to 6% and 10% of the risk for a deal, but in view of many different conditions. And thusly, on the path of your development, you will create your own risk management rules, your own capital management rules, and you will be able to create money management rules. And of course, creating a transaction journal and introducing it for self-analysis and improving the trading system. In fact, a transaction journal is for me personally, and I advise all students to definitely introduce a transaction journal. The transaction journal is an important component in your development because thanks to the transaction journal, you will see the distance. You will see the distance in the form of results and in the form of your own development, because trading is not about learning and going to work. Trading is about constant work on yourself, constant improvement of your trading strategy, and the transaction journal will help you see your statistical changes in the form of win rate, average loss, average profit, and so on. Fortunately, there are automated services that I shared on Twitter and in the Telegram channel which you can use to run a journal. It is not necessary to enter an Excel table for this.